Yes, a new year will be dawning soon, and thankfully, there are some hopeful signs that 2021 will be a year of recovery, a year of progress, and a year of opportunity. However, of course, there's also going to be more challenges. So the question is, are you prepared? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. As you know, there's little doubt that 2020 will go down as one of the most challenging years in our nation's history. Once-in-a-century pandemic that disrupted our lives and shredded our economy is the main reason, of course, but not the only reason. So as 2020 winds down, promising vaccines are nearing approval, and these vaccines may help us finally beat the pandemic and return to some degree of normalcy in the new year. When and to what extent that happens remains to be seen. But either way, it's important to prepare now for potential changes, challenges, as well as financial opportunities that may arise in 2021. We'll talk about some of those on today's show, and we'll discuss some other retirement planning issues that could affect you in the coming year. Joining me and my co-host Jeff Small will be Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom Report. We'll also talk to Matthew Johnson, president of Johnson Wealth and Income Management, a retirement income store located in Iowa. But before we get to our first guest, let's talk about some things to think of as you review your retirement goals and your financial strategy heading into 2021. It's traditional to celebrate when a new year starts, and it's a safe bet most people will be eager to celebrate New Year's Eve this year. The irony is that we won't be able to celebrate with parties and large gatherings because we're still in the grip of the pandemic. However, it's important to remember that no matter how anxious we are for 2021 to arrive, nothing is going to magically change once we flip the calendar. Deep down, we all know this, but psychologically, there's always a danger of clinging to unrealistic hopes or expectations in times like these, only to find yourself disappointed once reality sets in. So here's the point. Even if coronavirus cases dramatically decline and the economy vastly improves in 2021, it's going to take time, possibly much of that year. In the meantime, the financial markets are likely to experience ongoing bouts of volatility and possibly another correction, depending on whether any big setbacks arise on the road to recovery. Those setbacks might take the form of another major economic shutdown due to the pandemic, or a tightening of the gridlock in Washington when President-elect Joe Biden takes office. With all this in mind, I believe it's important to reassess your risk tolerance as you review your retirement plan with your advisor heading into the new year. It may be that after discussing all the issues and looking at your current asset allocation, you want to decrease your investment risk. As you know, if you're a regular viewer, an advisor who specializes in income-based strategies, such as individual bonds and bond-like instruments, is uniquely qualified to help you achieve that goal. Why? Because those strategies are designed specifically to help protect your principal from market volatility while generating reliable income in the form of interest and dividends. On the other hand, if after reviewing all the relevant factors, you realize your risk tolerance is actually higher than you thought, you may want to make changes to your portfolio that allow you to take advantage of potential new opportunities in 2021. Opportunities as buying back into the stock market when the time is right. This can be done while still shifting your focus from portfolio growth to retirement income, provided you use the right strategies and have the right risk tolerance. As I stress frequently on this show, I believe making that strategic shift from growth to income is vital once you're retired or within 10 years of retirement. In fact, that's why we call this show the income generation. So what are some of the new opportunities that might emerge in 2021? And how can you take advantage of them with an income-based portfolio? We'll talk about that coming up in just a bit. But right now, let's welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. We also want to bring in Dr. Marc Faber, a good friend of the income generation. Marc is an author and the editor and also publisher of the Gloom, Boom, and Doom report. His newsletter highlights unusual investment opportunities, and it's available on gloomboomdoom.com. Dr. Faber, thanks for joining us today.
It's my pleasure. Thank you for having me on your program.
Oh, you're very welcome. You know, you oftentimes, well, first of all, I got to say something. I usually ask people how COVID is treating them, but looking by the size of that beard, COVID has definitely made some changes in your personal life, has it not?
I've become a hermit.
Exactly.
You see,
we all have.
I can travel within Thailand, but at my age, and especially given that I smoke a lot, COVID is a certain danger. So I prefer to stay home, and I have a very large office, and I have a living house, and I have the dogs and the trees and the birds and everything. So I don't really need to go out a lot. And traveling overseas is not possible. It's in theory possible, but to come back to Thailand is then very difficult because of difficult quarantine requirements, very strict quarantine requirements.
So you become a bearded hermit. Got it. So, you know, you catch a lot of flack sometimes for being excessively bearish or negative about things. But, you know, your prediction, we spoke back in July for second quarter GDP wasn't as bad. You thought the second quarter GDP loss was going to be maybe 15 or 20% maximum, and of course it was double that. But you also said that, you know, the economy will recover after that, and the stock market might keep going up, which has happened. So I want to separate our discussion today into economy and then the stock market. So first, the economy. Economically, what do you see now going into 2021 with the economy that we need to be concerned about?
Well, I think we are at a highly interesting juncture at the present time, and let me explain why. The technology stocks, as you know, are in the sky, the so-called FANG and related stocks. They're very highly valued. And then you have thousands of stocks around the world that have very low valuations. These stocks are resource companies, and they are energy and energy-related companies. They are banks in emerging markets, but also in the US and especially in European markets. And you have material and industrial stocks that are very depressed. And these companies, in theory, and I'm betting that under Yellen as the Treasury Secretary, the deficits will be astronomical, and that at the same time there will be plenty of money printing, which will lead to a weaker dollar. Already today, the euro against the US dollar has gone up 7% this year alone. Now, I expect the emerging market currencies that were very weak in 2020 to gradually recover in 2021. And the emerging market economies and stocks that have been essentially in a 5-year bear market already, that they will bottom out and start to recover. Because when you think of it, many companies have a tiny market capitalization compared to, say, Apple and Amazon and these type of shares. So when these type of stocks go down, there are two possibilities: that they pull down the entire market. It's possible. That was the case in year 2000 to 2002. But it's also possible that when the Nikkei went down after 1989 by more than 70%, the money flowed from the Nikkei, from Japan, into other countries. And as you know, in the 1990s, US tech stocks went ballistic. So both are possible. And I'm betting that inflation will make a comeback. We've bottomed out in the commodity cycle, in my opinion.
So, Dr.
And
Faber,
I
let
think
me
that's
ask you this. We have 30 seconds left in this segment. Do you think inflation will
Yes.
make a comeback in 2021, or do you think maybe 2022 and beyond? 30 seconds.
Look, everything depends on how you measure it, even elections, as you know. But I think that commodity prices have bottomed out, and I think that food prices will go up, and that inflation will begin to accelerate.
So even in 2021, we're going to see that. So let's
Yes.
take our commercial break. I know Jeff's chomping at the bit, sitting here waiting to ask you some things, possibly about how the stock market might be affected by the election. Dig a little deeper on where you're going with that. So stay with us. We have more coming up in just a moment.
Sure.
I'm Dave Scranton. I'm here with Jeff Small and Dr. Marc Faber, and we'll be right back. As you know, in spite of the overall economic damage caused by COVID-19, some companies and industries have actually seen their fortunes rise during the pandemic. Technology, telecommunications companies like Zoom have benefited from this new normal for obvious reasons. So have home delivery services, makers of cleaning products, and online shopping giants like Amazon and Etsy. Most market watchers agree that these companies and these sectors are likely to continue performing well into the new year, since the shift back to our pre-pandemic world is going to take time, even with an effective vaccine. So the fact is simple. Some of the changes we've made as society in the last 8 months or so are probably here to stay. At the same time, all of us are anxious to return to the social activities that we all used to enjoy. Things like taking trips, seeing a movie, going to a ball game or a concert, or just eating out at restaurants with friends. If it turns out we're able to safely get back to these things by mid-year, the industries hit hardest by the pandemic will start to rebound. These include the leisure and hospitality industry, so restaurants, also oil and gas, airlines, travel, and more. Here's the bottom line. There may be a variety of good opportunities for investors in the new year. Even if you're investing for income, you may be able to take advantage of these opportunities, provided you have the right risk tolerance, the right strategy, and the right advisor. Now, in terms of risk tolerance, it's important to understand that investing in the stock market is inherently riskier than investing in bonds and bond-like instruments. Why? Because while the bond market does fluctuate, it typically doesn't rise or fall as quickly or dramatically as the stock market. In addition, there are ways to invest in the bond market that are contractual, strategies that can help protect your principal against loss while generating a fixed income in the form of interest or dividends. These contractual options don't really exist in the stock market. With that said, if you do have the right risk tolerance and you want to stay in the game, an actively managed portfolio of high dividend-paying common stocks, value stocks, can be a much better way to go about it after age 50 than staying invested in growth stocks. As you may know, growth stocks are those currently in favor with the markets and increasing in value based upon momentum. Value stocks, on the other hand, are those that are out of favor with the markets and therefore trading below what analysts see as their true value. A few potentially good undervalued dividend-paying stocks that analysts have identified for 2021 include things like Pfizer, the company at the forefront of the vaccine effort, aerospace giant Lockheed Martin, and H&R Block. Value stocks are potential bargains and good options for certain income-based investors. Why? Because your return comes in the form of dividend income as well as capital gains. But understand, however, that investing for dividends can be more challenging than investing for growth, and that you need the right experience to be able to tell the true values from what we call value traps, which we'll talk about more coming up in just a moment. And right now, let's bring back my good friend and co-host, Jeff Small, as well as our guest, Dr. Marc Faber, editor and publisher of the Gloom, Boom, Doom Report. Jeff, you sat around so patiently in the last segment. Why don't you take it away?
So, Dr. Faber, you're over in Asia, and you know what? I've been getting lots of questions from folks who are saying, as investors over here, from our audience and from our listeners, should we have some money in emerging markets like in your space over there in Asia and China? Because China has seemed to have licked the virus or beaten the virus better than anybody. And one of the reasons why they did that, how they beat the virus, is their society has already been extremely restrictive and conditioned for these types of respiratory viruses. They've been dealing with this for a long time. And so their society is much more compliant. But now the outlook economically for China is significantly better than anywhere in the world. Their GDP is outpacing everybody else's. And everybody over here that's an investor is wondering, should we have some money in the Asian markets right now, in emerging markets in that direction, because they seem to be recovering from the virus quicker than anybody else?
I think this is a very good question, but it should be formulated whether an investor must have some money in China and in Asia in general. I came to Asia in 1973, in other words, soon 50 years. And one of the reasons, aside from the beautiful women that live in Asia, was that the economies have so much more potential than Western society's economies. I think that people, when you talk about the coronavirus or COVID-19, I think that because we had the bird flu and so forth, if you tell the population, look, you better be careful. And when you go into a shop or in a restaurant or into a bank or government building, you better wear a mask. It's not necessarily a must, but it's an advice. I think people listen and do it. We don't have democracies to speak of in Asia, but we have a lot of economic freedom. And I think people are quite reasonable when there is a crisis like this. And we know in Asia, we have a lot of high density cities.
Well, and you know what compounds my question as well is that now that we've had, looks like a transition from the Trump White House to the Biden White House, there's an anticipation that trade is going to become friendlier towards China as well. So there's an inertia here from Wall Street on throughout the country that, you know, as investors, we should have some money allocated in the Asian marketplace, specifically China, like you said. So how do you see the Biden administration impacting global trade going forward? Do you think he's going to let down the barriers, or do you think he's going to carry the same Trump torch of protectionist policies and trying to take advantage of, and when China tries to take advantage of the predatory style that they utilize in their trade wars with us?
Well, let me answer this question as follows. You know, Mr. Trump, he was against NAFTA. What has happened, they kind of made a new agreement with the result that in October of this year, the trade surplus of Mexico with the US was the highest ever. And Chinese trade has continued to actually grow. And for China, for many companies, the US is a tiny market. They have markets in Africa, they have markets in Eastern Europe, in the Middle East, in Latin America, and so forth. So the US is no longer the most important market, it's still the largest market. But by region, exports to emerging markets from China are much larger. So I wouldn't invest in China or not in China because of the US. But one thing I want to say, the Chinese market is a huge marketplace, 1.3 billion people. And I think an investor, like at the end of the 19th century, if you were a European investor, you had to have some money in the US because that was the future of the world at the end of the 19th century, beginning of the 20th century. And now the future is really in Asia, not just in China. People seldom talk about India, but India is also more than 1 billion people. And I think that money
Dr.
is
Faber,
actually...
let me switch back because we only have a minute left, and I want to switch back to the U.S. We get it. We need to have some money in Asia. I understand the rationale for sure. But you also said that interest rates with Yellen printing of money is going to be greater. It keep interest rates low, maybe make them lower. Ironically, that actually helps growth stocks like tech stocks more than it does value stocks. So 30 seconds, your best crystal ball. 2021 in the U.S. stock market, it's going to be an up year or a down year? 30 seconds.
I think it will be an up year for oil stocks and for bank stocks and for resource companies in general. I think it will be a down year for the FANG and FANG-related stocks.
Gotcha. In spite of all the printing of money, yeah, they've had a good run. So I can't argue. You might be right. We need to leave it there. Thanks so much, Dr. Faber, for being with us.
Well, thank you very much for having me. And I wish your viewers...
You stay with us too. We have much more coming up in just a moment right here on The Income Generation. We'll be right back. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749, online at theretirementinComestore.com.
While having the right asset allocation to achieve your goals is one key to a sound retirement plan, it's not the only key. Decisions you make around things like Social Security, taxes, estate planning, required minimum distributions are also crucial. So it's important to be aware of changes and potential opportunities related to these issues as well. There are several coming or potentially coming for 2021. For example, the Social Security Administration recently announced several changes for next year, including an annual cost of living adjustment or COLA increase of 1.3%. Recipients will see this small increase in their monthly payments starting in January. There's even better news for high earners. Maximum monthly payouts are increasing. After capping monthly benefits at $3,011 for recipients of full retirement age in 2020, the maximum payout will increase next year to $3,148 a month. That's an extra $1,644 a year for high earners who meet the right conditions, including having waited until full retirement age to collect. Now, of course, recipients aren't the only ones affected by changes to Social Security. For example, the payroll tax cap for funding Social Security goes up every year, and it will go up again in 2021 by $5,100, making all earned income up to $142,800 taxable based upon FICA. There are also some changes next year related to earnings test limits, accrued work credits, and Medicare premiums. And the right financial advisor can help you understand these challenges and whether they may create new challenges or new opportunities for your retirement plan. Now, in addition to Social Security, Congress is reportedly close to passing a follow-up to its 2019 Secure Act, which introduced a host of new laws and provisions related to retirement planning. The Secure Act 2.0 would bring even more changes, including automatic enrollment in employer-sponsored retirement plans, and another increase in the age for taking RMDs, required minimum distributions. The original Secure Act raised the age for taking RMDs from 70.5 to 72. The new bill proposes lifting it to age 75. A major change that would give investors an additional 3 years to grow their retirement accounts tax-free if they wanted to, or I should say tax-deferred. Another provision in this bill would make it easier for employees to find lost retirement accounts by creating a national database, a change that recognizes the workforce shift toward moving from one company to another rather than staying put for decades. Like the potential opportunities and challenges arising in the financial markets, these changes may or may not occur, depending upon whether Secure Act 2 passes. Even then, the changes may not affect you. Nevertheless, I believe it's important to be aware of them and to discuss them with the right advisor now if you don't want to miss out on a potential new opportunity or be blindsided by a new challenge. Now it's time to welcome back my good friend and co-host, Jeff Small. So Jeff, inflation. I understand the argument that all this printing of money creates inflation, but is it really going to happen moving forward? Dr. Faber seems to think so. But again, what we saw for the last 12 years was the Fed trying to create inflation by printing money. And all they did was create asset inflation. They create real estate prices that have gone up, stock prices that have gone up. So do you think that's going to change, or do you think we're going to continue more of that and not necessarily have price inflation the way Dr. Faber worries about?
I don't see price inflation, Dave, happening whatsoever. I think that's a dream. I think we're going to see things like commodities in the energy space marginalized by way of executive order, and the production capacities are going to diminish dramatically as the economy comes back. We're going to see inflationary prices on energy, but only because those production capacities and regulations are going to be reinstated by the Biden administration. I don't see inflation being created naturally by supply and demand. I do see massive wealth gap inflation occurring. No doubt about that. That's going to get worse over time. The more money we print, the higher asset prices get, more people get left behind. And there's nothing anybody can do about that. Doesn't matter what your political persuasion is. That has no bearing on it whatsoever. This monetary policy that we have in place has now become an addiction. We're going to keep expanding debt to the nth degree because we've got no choice, Dave. We've got no choice but to do that.
Yeah, you're right. It's a sad state of affairs when the disparity between the haves and have-nots gets wider. But I think, that horse is out of the barn. I don't think there's a way to necessarily put it back in. And you're right, we've seen some inflation now over the last couple of months just because companies have slowed down production to decrease the supply of goods. And of course, the demand came roaring back, so that pushes up the prices short term. But long term, we need to see production go back up again. I think we will. And if we don't, I think the government will come up with incentives to make production go up. Because think about it, if production stays low and prices start coming up, that's a double-edged sword for people, because now not only will there be higher prices with inflation, but there's also going to be more people that are unemployed. So the government wants production to go up so they can employ more people. The challenge is, how can you employ them in jobs that are meaningful, where they have a chance of actually climbing up the economic ladder, if you will?
Well, you can employ them with jobs, especially when you have a policy that's going to be pro-globalization for economics. The middle class has been squeezed for the last 50 years as we've outsourced every industry, every sector, every manufacturing position goes offshore somewhere to either Mexico or some emerging market country where the hourly wage is $2 an hour. And both political parties put their blessing on this and sanction it. So they're both to blame for the demise of the middle class from that perspective. As opportunity wanes, Dave, over the course of time, people gravitate more towards the government as a form of financial dependency and existence because they can't get out of the gate. And unfortunately, we're going to see that times 5 the next 2 or 3 years.
Yeah. And a Biden administration, of course, is going to do just that. It's going to allow jobs, maybe push jobs overseas. I've said before right on the show, my biggest concern is that we see corporate tax rates go skyrocketing back up again. And if we see corporate tax rates anywhere near 30%, let alone the 35 we saw before, we're going to, jobs will start to go back overseas. And companies will start to go back overseas. And that's not good for the U.S. in any way, shape, or form. But the question is that a reason to invest in the Asian markets, as Dr. Faber mentioned?
Well, I will tell you that for the income generation, you talk about investing in China and they start to cringe. They start to cringe because they know that China is one giant economic predator among predators trying to conquer the United States. And so until the United States gets serious about combating China with an actual policy where we get off of their existence of being dependent upon their trade, I don't think we should invest in China, Dave. I think it's a moral imperative not to invest in China just for that reason.
And besides, if we did want to invest in China, as analysts, how would you or I know that we're getting the right information, right? I mean, think about that. I mean, some of these reports that have come out of China in terms of GDP growth just over the last bunch of years, 7-8%, we question, and a lot of it's artificial. Dr. Faber talks about the money printing here in this country and how that creates artificial growth. But, China's done it for years. All these empty buildings that are all over Asia.
You're exactly right. The financial restructuring of China that needs to occur is ginormous. They have cooked up the books and printed up more money than most countries combined on the planet. But their numbers, you can't tell what their numbers are. Who knows what their numbers are? You just don't know. The only thing China has over everybody else is 1.3 billion in their population.
Mm-hmm. Yeah. Well, all good points, man. All right. Well, listen, we got to take another commercial break. You stay with us. We have more coming up right here on The Income Generation in just a moment. We'll be right back. I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Don't waste any more time. Visit myfreeretirementreview.com to find out if you have the right retirement strategy in place.
The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. Welcome back to the Income Generation. I'm David Scranton. I'm here with Jeff Small, and another good friend of the Income Generation, as well as a personal friend of mine and Jeff's, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income store located in Iowa. So Matthew, let me ask you, we just got through Thanksgiving. What are you most grateful or thankful for?
Well, that's going to be a fairly lengthy list, but I would say the first thing is my children. I am blessed to be the father of 4 really amazing kids. I just got done going through a personal battle with COVID-19, so I'm very thankful for my health. I'm very empathetic now to those that have gone through it. And I am thankful, Dave, above all else, for the ability of being in the best job in this world. And that's the job of being able to help people and to help people succeed in retirement. It's the most fulfilling job or occupation that I could ever think of.
Mm-hmm. Great. Well, I know we have a second and a third here between Jeff and myself. So, okay, then let's put some meat on it right away. The stock market next year, 2021, we have all this printing of money, which long-term, scares people, but yet, even with Joe Biden being the obvious now, president-elect, with Janet Yellen coming in, who's a little bit more liberal in the Fed, it seems like the markets don't care. The markets are still happy about everything because they want that free money. So is 2021 going to be a pretty good stock market year?
Well, I think that we're an optimistic bunch, aren't we? And there's a lot of things that are supporting the market right now. And of course, just like you said, Janet Yellen, we've had experience with Janet Yellen. She is very dovish. But at the same time, I think that investors, or at least in my area, were very realistic in acknowledging of what could happen. Janet Yellen, at least my recollection of her was that she was probably one of the biggest proponents of negative interest rates of all the different chairs. And I think that she would not necessarily be afraid to push that button if she wanted to. And yes, there is a lot of still good old fashioned values in this country. And they see the quantitative easing and the printing of money and the manipulation of interest rates. And they don't like what that ultimately leads to. But yet we've got a lot of investors that are okay with it because they know what it does to the stock market.
Well, on that note, MJ, you know what's going to happen with all that money printing? You know what sector or what segment of the stock market's been left behind the most this year? You guessed it. The value stock sector is the one that's going to probably lead out front and may even outperform the NASDAQ sector because those stocks have all hit their all-time peaks, and really there's going to be rotation back into value. What do you say about that?
I'd say that that's a very, very good observation, and I would totally agree with you. There's a lot of people, a lot of investors that think that finding growth stock is more difficult, say, than value stock. I would disagree. I would say that when you're investing in growth stock, you're basically looking at trends, you're chasing momentum. When you're looking at value stocks, though, value stocks represent a tremendous opportunity. But we have to be very careful because value stocks, they can carry the word value, but they can be a value trap. And what is a value stock? It's basically, the stock of a company that's been beaten down because of circumstances or whatever the case may be. And unless you're willing to put in the work, the effort, the due diligence that's necessary to make certain that the fundamentals of the company are very, very sound, You could be buying a stock of a company that's discounted, but if it's a value trap, it's just always going to sit there. So there's something to be said about working with a firm that does the due diligence to really find those hidden gems of value stock companies that we feel strongly are fundamentally sound. And when you buy them, the quote unquote recovery is actually turning into capital appreciation for you as the value stock investor.
And the most importantly is that for the income generation, value stocks tend to be the higher dividend payers.
I agree.
So although it's harder to execute, and we always say, don't try this at home, right? Because it is more difficult than just chasing growth, chasing momentum. The reality is it's the kind of stock, some might argue maybe the only kind of stock that's most appropriate if you're talking about any significant amount of our income generation members' retirement funds. And you're right. I mean, we must be right, because even Marc Faber said, right, in our interview just a moment ago, he said, you know what? He goes, tech stocks are going to underperform in 2021. Look at financials, look at oil, look at some of the value stuff. So hopefully we're right. But we need to take a quick commercial break. We got more coming up right here in just a moment. I'm David Scranton. I'm here with Jeff Small and Matthew Johnson, and we'll be right back. Welcome back to the Income Generation. We're here with my good friend and co-host Jeff Small, as well as our good friend Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income store located in Iowa. So this concept of a higher dividend paying value stock. So it sounds, Matthew, like you're saying it's not just as easy as buying these blue chip stocks, buying these dividend aristocrats and sitting back and collecting a dividend, because some of those are value traps. Some of those are going to continue to depreciate in value. Is that correct?
Yes, absolutely. I think that there's a tremendous number of investors that have thought just because they're chasing something with a dividend that was going to lead to growth. And unfortunately, it doesn't always work that way. That's the reason that the due diligence that I spoke of earlier is so very important and vital.
Yeah, cheap, sometimes things are cheap for a reason. Sometimes they're cheap because, hey, they just knee-jerk reaction, they're out of favor with the markets, but they're worth more. And sometimes they're cheap because they're going to go even cheaper. They're just not worth a lot. Isn't that right, Jeff?
They really are. And so it's almost impossible for an average investor to discern the value stocks. And so when you say the word value stocks, and a question mark immediately pops up over everybody's head. What in the world is a value stock? Well, there's value stocks in every segment and sector of the market. So value stocks tend to be the ones that have the best balance sheets, that are consumer-based, that people like to utilize on a consistent basis. And so what we look for are those stocks in those spaces that are producing the highest dividends, or a combination of dividends and appreciation. But you have to work with somebody like Matthew Johnson to know how to do that.
Yeah, like I say, don't try this at home. So, okay, we all want to be hopeful. We all want to be optimistic for next year. Matthew, tell our viewers, what do you think they should be focusing on in order to maintain that optimism, that positivity into 2021?
Well, it's interesting that you asked that question, because this morning I did one of my YouTube videos, and I'm reflecting on the fact that wherever we are in life, we are where we are as a result of our decisions. And really, it's our responsibility. We need to take responsibility. If your health isn't where it needs to be, if your spirituality isn't where it needs to be, if your business or your finances aren't where they need to be, then you need to take responsibility for that. And I'm a firm believer that, not only as an investor do you want to be looking down the road. That's important, obviously, but you want to be also paying attention to what your immediate needs are today. And I think people need to pay attention to both, because the cost of living is continuing to go up as they're printing money. And we need to be looking for ways that are going to be moderately safer to get appreciation on our money. That's going to be those value stocks. And I think we need to also be focusing on the income. who couldn't use more income? And here's the irony, Dave. The irony is that if you want more income from your money, you naturally have to reduce your risk. And I know that sounds so counterintuitive to so many investors, but it's the way that it's always been. And so I think we need to really be attentive going into 2021. What's my need for 2021? We're going to have crises. We're going to have things that change, but we need to be focused on what our money is doing and take responsibility for that.
Yeah, great point. Exactly, Jeff.
Yeah, it's I think consumers, MJ, end up with this dilemma where they think that it's the advisor's responsibility, but first, you as a consumer or an investor or retiree, you have to be the one that takes responsibility for your money. And then it's the advisor's job to educate you on what it is you want to accomplish. And that's the difference. And folks aren't willing to cross that line sometimes. But we know that in order to do the best job, that's what we have to do. Correct, MJ?
It's funny because, MJ, you said something about, the income you need, but I would say the heck with what you need. How about what you want? I literally was on the phone yesterday with somebody who had several $1 million who has some cars that he wants to fix up that he has, collectors. And he doesn't want to do it because he doesn't want to have to talk to his wife about why he's selling investments to do it. And I said, gosh, with the money you have, if you just earned 4% interest in dividends, you could fix up all your cars within a couple of years and have great collector's items. And you can do it without having to sell principal. That's a whole different conversation that you have when you go home. So 30 seconds. Matthew, what are your goals? What are your resolutions for 2021?
Well, it's probably going to be quite different than what you expect. So this year I was blessed. 2 years ago, I decided that every year my staff and I would take and we would provide Thanksgiving meals to families. And so the first year we started out, we helped 3 families, and we felt really great about that. And this year, 2020, we did 10 families. And so my staff and I, next year in 2021, we're going to support 21 families for Thanksgiving, which I think is better than so many other things that we could be doing.
Wow, I love that, Matthew. That's a great resolution for next year. Good for you. Thanks for being on, and God bless.
Thank you. It's always a pleasure.
You stay with us. We'll be right back here in a moment on the Income Generation. I'd like to take this opportunity to thank our guests, Dr. Marc Faber and Matthew Johnson, as well, of course, as my co-host and good friend, Jeff Small, for joining me today on the Income Generation. I also like to thank you, our new and returning viewers. Odds are many of us are feeling a bit like this, or a lot like this, as we move closer to the end of 2020. It's been a rough year in virtually every conceivable way, and we're all hopeful things are going to be a lot better and brighter in 2021. There are some encouraging signs that it will be better, but it's not going to happen instantly when we flip the calendar on January 1st, because deep down we all know this, but it's important to keep it in mind as the new year draws closer. The recovery and the return to normal will take time, and there are likely to be new challenges along the way. There are likely to be new opportunities as well, and I believe it's important to prepare now. Why? So that you can be ready for them. You can start by reviewing your financial strategy with the right advisor. That is in the attempt to determine whether your current allocation is still in line with your risk tolerance. You may want to take steps to lower your risk to help protect your investments from downside. Or you might want to position yourself to take advantage of potential new opportunities that emerge next year. And if that's the case, you may want to discuss the benefits of actively managed high-value dividend stock strategies as compared to a conventional growth-based stock strategy. As we discussed, investing for dividend income can be a more practical way to invest in the stock market once you're in or nearing retirement age, provided, and that's a big if, provided you have the right risk tolerance and the right advisor, one who specializes in retirement income. And at the same time, you may also want to discuss pending changes or possible changes arising in 2021, changes around things like Social Security, RMDs, taxes, estate planning, and other issues vital to your retirement strategy. Here's the bottom line. The more you do now to prepare yourself mentally, emotionally, and financially, the greater your odds will be of making it a better, brighter year in 2021. As always, stay safe and thanks for watching. If you're close to or in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.